7:31, that's 29 minutes moving up to 8 o'clock. Welcome back to First Up right here on CTV. In this segment, we have our friends from the Unit Trust Corporation. We focus on what is dollar cost averaging. What you want to find out? Well, stick around. You're going to find out our guests are Karen Guyadeen Gosine, Assistant Vice President, Investment Management Services at UTC, and also Mr. Phillip Williams, Portfolio Manager at UTC. Ladies and gentlemen, good morning. Thank you for joining us this morning.
Good morning.
All right, start with the lady. Phillip is new to us, so we're going to give him another rest. Karen, what is dollar cost averaging, and why is it important to us?
Once again, thank you very much for giving Unit Trust this opportunity, to share with our unit holding public. We always focus on building investment awareness, and dollar cost averaging in particular is a strategy used by the passive investor, the investor who wants to minimize risk. And when you're investing, you look at two things. You look for return, and when you're chasing return, there's increased risk. So this strategy allows the investor who is not so savvy, who does not know how to read in-depth financial reports and whatnot like that, to actually invest comfortably. Right? The investor must have an extended period of time, because dollar cost averaging is putting aside the same amount of money at intervals that are equivalent, and also investing for a long period of time. What it does is it reduces the risk that the initial price, or the initial acquisition cost of your first investment, the gap between that and the current market value is reduced, because you're investing, let's say, $100 every month at the current market rates.
So it doesn't put you at a large risk area.
Yes.
So it's a pretty stable for non-adventurous investors.
Yes. So let's say the actual price of the investment is very high this month. If you were to invest all of the money that you have available for investment this month, it means that if it is markets were to tumble and the prices of securities were to decline, your average acquisition cost will not be far away from where the market is.
I want to rewind a bit as we bring Phillip Williams into the conversation. How important is the process by which the UTC goes through with a client or prospective client, the assessment of their needs, their goals, and their risk aversiveness or not, in terms of assessing that client's personality, so you know how to tailor what investment would work for that particular client?
That's of paramount importance. We will only be able to do our job effectively unless we know our customer. So particularly at the CSR level, that information is given. Even at our level, it depends on the client, so at the marketing department.
And what types of information or data are critical for the client to share with the UTC, especially at this introductory point?
Certainly, what are your goals? What you are looking for, say, over the next 3 to 5 years? Is it a medium to long-term goal? Because that's very important, because in this type of environment, I would say you need to be very certain and realistic in terms of what it is you're looking for, and that's the only way we can guide you down that, through the process.
So being very forthright with your information, what your goals are, whether you have medium-term to long-term goals, whether you want accessibility to your funds, whether you at this stage in your life, you're willing to take a risk because you can afford to at this point, right, Karen?
Yes, given how much time you have until retirement.
Number of paychecks, very important.
Number of paychecks, very, very important. Where you are currently, what your investment portfolio looks like. As you indicated, risk, how much money are you willing to lose at this point in time? And that may be an interesting perspective, because you don't invest to lose. But markets do decline and they rebound. And so within the time frame, the time horizon that you have set out based on your short-term, medium-term, and long-term goals, you want to ensure that you can invest steadily and make a decent rate of return and reduce the dollar that you have at risk on your portfolio.
To protect yourself. Phillip Williams, let's talk about, Karen indicated on yourself, the primary objective and benefit of dollar cost averaging is, of course, the stability. The fact that you're investing not far from the range of the value of the dollar at that point. Correct. What are the other advantages to it?
Essentially, it lowers the cost per unit to the investor, and thereby enhancing their return. Because if you think about it, if you, as Karen, let me just reiterate what Karen said, it significantly reduces the risk of investing at an inflated price. Because you don't want to come in today and let's say next week or 1 month down the road, what you could have invested at today now is a lot less. So your return can be eroded. So but just think about it theoretically. You're investing, let's say, $100 for 3 months. If the first month the price of the unit or price of the asset, whatever it is you're investing in, is $10, you're going to put 10 units. If it's $20, you're going to put 5 units. And the second month, the third month, if the price of the asset was $20, you're going to put 5 units. If you took an average over that period, you end up with approximately 8.5. So had you invested in the first month at $100 now, you would have been paying more. So it increases your chances to get a higher return.
So once again, it protects you. Karen, when will the implementation of a dollar cost averaging strategy be most effective in someone's investment life?
Now, it's important to understand that you need to invest consistently, because you can't invest today and stop if you have a retirement goal, right? But this strategy will be most effective when prices are reducing. So as prices fall, you are able to buy more and more units at the lower cost, thus reducing average acquisition cost. Now, if prices are constantly increasing over time, you'll be increasing your average acquisition cost. And then, as an investor, what you need to look at is there still value in the market? You know, is it that the market is at a peak, and is it that, you know, you're going to expect a trough afterwards? And so you want to ensure that you know the companies, right, that you're investing in, that you are comfortable with them, that they're best in class. And if you do not have time to get that sort of information, go to a fund manager, mutual fund manager like ourselves, UTC, and evaluate the portfolios. You know, on an annual basis, we put out our top 10 holdings in our annual reports, so you can actually get a feel for the concentration of the assets within the portfolio. Once you know that you're investing in companies that you are comfortable with, and not only individual companies, but you could also invest in ETFs, exchange traded funds, you could invest in other mutual funds, but it is important to ensure that there is value when you are investing.
Phillip, let's talk about the types of signals we should look for in those said companies that Karen outlined. What should we be looking for in those companies that would fall under this category?
For the type of investment?
Yeah.
Certainly, you want to know that the fundamentals are strong, and you believe in investment. Sometimes investors, it's all right.
So what are these fundamentals? Balance sheet?
Strong balance sheet, cash in hand. Cash is king. Not too much debt, because, I mean, simple, if you think about it, if you go to the bank or if you have too much credit, it's the same way I'm going to look at a company. And if you have too much debt, it therefore means the likelihood of you probably paying me back, or the likelihood of you generating, you know, a reasonable return.
It increases my risks.
Yeah, it increases the risk. So those are the, you know, key things. But mainly, as you're correct, Paul, strength in the balance sheet.
And stability. And would that type of information be readily available, Karen?
Yes, that information is readily available for all public companies, so that you can, very important, you can look at the balance sheets, you can look at the quarterly filings. There's less information in the quarterly filings, but at least it gives you an idea as to, you know, how the company has done since its last full report. In addition to that, as an investor, you have to determine what do you want out of investment. So some investors may go for income, right, if it is you're closer to retirement. And so you would look for, in choosing your stock portfolio, you would look for dividend paying
because you need access
stocks
to your funds.
Yes. Or you may, if you're early in life and you have time on your hands, you look for growth stocks, you know, but then different stocks perform in different environments in terms of the economic environment. So when you do your top-down analysis in terms of, you understand how the economy is performing, then you understand which sectors within that economy are performing, and then you drill down into which companies will be able to capitalize on the opportunities available in the market market, you invest in those companies.
And Phillip, let's just go through in terms of, because one of the mantras of the UTC in their time with us over the last couple of years is diversify, diversify, diversify. Even within dollar cost averaging, how diversified can your portfolio be?
Well, you can be diversified. Let's say, for example, somebody may be more aggressive than the other investor. But with everything, risk versus reward, if you want to have a more balanced approach, you can say look at the income type products that will defend your portfolio, defend your investments. Then you take a look at the equity type products. So there's the North American fund, the energy fund, the Asia Pacific fund. We have a suite of new funds. So we're marrying that approach, taking a balanced approach, the diversification and the dollar cost averaging. And
so you'd have a pretty diversified suite of in your portfolio. So you're protected, but you have some gains that you can get down the road. Yeah. And Karen, I mean, and there's a tendency of new investors to be hands-off, even especially with a credible company like UTC. How important is the fact that even if you're not savvy, you're not new, you really need to become accurate and keep up with the movements of these companies on the stock exchange and familiarize yourselves with the information available in their balance books, so that you yourself have a particular level of comfort with the advice given to you, though the UTC is credible, and you can also begin to now monitor yourself on the international outlets.
You're correct, because remember, when you're taking an equity position in a company, if you're investing in a stock equity, you're taking the residual value in that company. So in the event of a liquidation, and we don't really want that situation to be in such a situation, but in the event of a liquidation, you will be paid after all others are paid, right? And you don't want to have that value being zero, certainly. So you need to understand on a basic level what the company is about, what they're investing in, what is their potential. Look at the management of the company, you know, look at their experience collectively, their track record, extremely important, because you want to ensure that your retirement money is there for you, because you will not be earning money during retirement. You need to live and enjoy your life.
And also, even if you're taking a chance, you have it balanced off with a more stable investment so that you don't lose on either end.
Certainly.
You can gain, but you're still stable and in terms of the implementation of a dollar cost average strategy, as you go into this approach, what are the major things that you should look at and start with, Phillip?
Firstly, you need to be realistic and choose an amount that is realistic for you on a monthly basis. People's situations are different, because it can get very frustrating. You have these goals, so you plan out and maybe you invested a certain amount this month, but you're not able to do it either monthly or quarterly. So certainly be very realistic in the amount, work out the frequency. We will recommend monthly or quarterly, and choose it for a time that you know you can do it for years.
Based on your goals, based on your timelines.
You can do it for years. And you don't want to, again, just to reiterate, this is for the low risk tolerance investor. You don't want to put in all at once and then you find yourself at risk now. The price has declined.
Balance it off.
Yeah.
Yes.
Give yourself some flexibility. Karen, finally, let's look at clients to come in with in terms of their readiness for this, for the pretty new, the novice client, and also the one that's been in it a while. What are the options for growth and change within the scheme?
Okay. If it is you're looking for growth at this point in time, you need to invest in stocks. Our view is that, you know, now is the best time, but even so, when you look at, although GDP globally isn't where we would like to see it, several central banks through monetary policy has been supporting asset prices through QE3 programs, etc. And so we expect assets to perform currently and into the near future. And so for growth, you need to put some of your investments in stocks, right? Fixed income products will not give you growth. They will protect your capital now, but as you venture out into stocks, you need to diversify when you're now starting. So look at mutual funds, look at exchange traded funds. Within our mutual fund suite, as Phillip said earlier, On the growth side, we have, first of all, the Growth and Income Fund, which is a TT dollar fund, where we actually guarantee the principal once you've held the investment for 3 years. So that's like a win-win situation.
So you don't lose anything, yeah. You can't lose anything.
We're protecting your downside. So for the investor who is now trying to get their feet wet into this type of investments in terms of stocks, I would say look towards the Growth and Income Fund first, and then diversify into the sector-specific fund like our energy fund, because you know there's more risk in the energy sector. Diversify geographically into the Latin American fund, into the Asia Pacific fund, into the European fund.
In those areas that you've seen stability once again?
Not only stability, but there are times when asset prices do decline and you see value going forward. You don't wait until there's value in the market to buy high prices.
And then,
so you take advantage.
So a bit more risky, but you have options down the road.
Yes.
Thank you very much. And more information once again at ttutc.com.
Thank you.
All right, you're welcome. We've been talking to Karen Gosine and Phillip Williams from our friends at the Unit Trust Corporation. Once again, go to their website, always active, always helpful, ttutc.com. We'll take a short break and come back with our final segment right here on First Step. Stay with us.